everyone, welcome back to my channel. So today's video is focused on providing useful trading information that is especially for beginners seeking to become more advanced. For this reason, in this video, I won't be sharing a bunch of typical information. In these types of videos, I like to ensure that the content is more so on topics that aren't often considered because I think that these concepts that I'll cover are helpful to keep in mind to help new traders grow as investors. So first up, I want to discuss VWAP, which isn't too complex. Of course, it's the volume weighted average price, and this is an indicator that can reveal a lot more than it might seem. Some points about the VWAP traders don't always fully recognize, but the role and the nuances are always going to be something to show market sentiment. So the image you see here on the screen is a price chart with the VWAP line illustrating a trading concept known as the bounce from the VWAP on a pullback. So within this, the horizontal VWAP line runs through the price candles, and this shows the average price of the asset weighted by trading volume up to each point in each time. Now the shaded section on the chart is labeled the pullback, indicating a point where the price briefly declined after a rise, touching the VWAP line. Now pullbacks often occur after a price increase as traders take profits or if the asset pauses before proceeding with further upward momentum. Then after touching the VWAP line, the price bounces upwards. Now this bounce suggests that the VWAP acted as a support level in this case, leading to a renewed buying interest that pushes the price higher to resume the upward trend. And with that, this pattern is often used by traders to identify those key entry points to go long if the VWAP confirms strong buying interest around a specific price level, and that's reflected here on the screen. And because the VWAP is weighted by volume, it can highlight the real price where most trading has occurred. And this can provide a sense of the underlying stock or ETF's direction. When the price is above VWAP, it'll likely show bullish activity, while a price below VWAP could hint at bearish momentum. All things considered, it's valuable for timing measures. Personally, I like to use VWAP as a signal for timing trades, especially in high volume scenarios. So for instance, if the price is testing VWAP as a support or resistance level or zone, it can be a decisive point for me to hop in a trade or to fully exit. So likewise, understanding how VWAP acts in certain setups can help you avoid untimely decisions. Now, what I really like about VWAP is that it can be viewed on multiple time frames to add depth. So that just means that VWAP isn't just for intraday charts. Using it on longer time frames like the weekly or monthly can provide clues on the bigger trend of the stock. And when the daily VWAP aligns with a longer-term VWAP level, it can signal even stronger levels of support or resistance, which can give an extra layer of confirmation. And I've mentioned to y'all before my preference on multiple ways of confirming trade signals. So of course y'all know I'm big on telling y'all about how it relates to institutional investors, and in this case, people may or may not be aware that they rely on the VWAP as a benchmark. So institutions use the weighted average to measure their trade performance with the goal of trying to buy below and sell above to ensure that they're getting the best price. So if your interest is in trading like a pro, it's good to know that the major interest around VWAP simply adds weight to its role, which is why price often reacts strongly around it. And the last thing I want to mention about the VWAP is that it's used in conjunction with specific trading techniques. Some options traders use VWAP as a part of a strategy to select strike prices or expiration dates. So for example, if the price is struggling to stay above VWAP, it could influence a trader to choose a closer expiration date or a specific strike price that aligns with the potential for near-term price movement. Okay, so next up, I want to discuss the order book dynamics as it relates to the market microstructure. And basically, in plain terms, what this means is that understanding the option chain goes beyond just seeing the bid and ask prices and volume at different strike prices. It involves studying the depth of the market and liquidity at each price level and patterns of order flow. So I know that sounds a bit complex, but of course y'all know I'll break it down. Now, the key thing about this information is that it can reveal hidden supply and demand levels that aren't apparent in typical price charts or beyond what is visible. For instance, watching the accumulation of large block trades can indicate unseen interest, potentially to help traders project a shift in the price direction. Now for me, this is relevant because the market microstructure looks at how trades are executed at specific prices, which by default allows traders to better time entries and exits. And I've also seen it used to anticipate short-term price swings and unseen liquidity. So the main thing to take away is that if you're looking at order blocks, this is the skill set that is especially useful in illiquid option markets, where mispricing and larger spreads create opportunities for traders who understand these underlying factors. So I hope this makes sense. All right, so moving on, I want to discuss the dividend impact on option pricing and the early exercise of decisions. So to be real with y'all, dividends can complicate option premiums on dividend-paying stocks. And again, this is something that's not widely discussed. This isn't super complex, but most people just aren't fully aware of it, particularly for money option contracts close to expiration. So what happens is when a stock hits the ex-dividend, the underlying stock price typically drops by the dividend amount. It's not something that happens 100% of the time, but it does happen often. But let me explain it simply. When a stock is expected to pay a dividend, this can affect the option's extrinsic value by reducing pricing, which may alter the optimal time to exercise. For example, for deep in the money options, traders holding calls might exercise early to capture the dividend if the time value left on the option is minimal, whereas traders holding puts may avoid early exercise to maintain the extrinsic value. Because of this, I specifically created a distinct trading plan around dividend timings because of the payout, all because of the shift in volume and price dynamics around the dates. Now, the nuance to this is that more advanced traders leverage this by waiting for dividend prime opportunities to adjust the approach and to optimize returns around dividend dates because they're strategically considering both the timing and impact on the option's value and the market behavior. Okay, so next up, I want to elaborate on the impact of implied correlation in stock portfolios. So if you've never heard of implied correlation, it measures how assets within an index or sector are expected to move relative to each other, and this is known as correlated assets. So this concept is necessary to learn in depth. As an example on options and of course ETFs, they have embedded implied correlations based on the underlying assets in the particular indices. And I'll show an example of this with SPY and QQQ in Thinkorswim in just a second. So how this works is when implied correlation is high, it suggests a strong alignment among market components, whereas lower correlation may signal that certain stocks are expected to deviate from the index of the movement. This correlation analysis helps traders and investors understand how closely assets are likely to behave under similar conditions and market exposure. And for that exact reason, advanced traders use implied correlation to identify precise scenarios where it's obvious that individual stocks' movement might differ from the broader market. So advanced traders monitor implied correlation very carefully to spot divergence opportunities. In many cases, trading individual stock options against index options if they believe an asset will outperform or underperform its sector. By trading options on both individual stocks and their related indexes, traders can exploit any misalignments in the expected correlation. But because this approach requires understanding of the components of an index and the factors that could lead to shifts in correlation, this can be attributed to economic news or sector-specific developments like emerging technology, for example. It is worth mentioning that the skill use of the implied correlation, it can reveal distinct trades that go beyond straightforward calls and puts on single stocks. And this just offers like a more sophisticated way to benefit from market inefficiencies. One of the best illustrations of this is higher implied correlation means stocks are moving more uniformly, which often results in lower market-wide gamma exposure because price changes are way more synchronized. And I'll make a dedicated video about this topic soon. But to get back to it, this technique requires a bit of knowledge of index components and any interdependencies within a portfolio, and that's just in order to fully benefit from the correlation-based analysis. I definitely want to show the market correlation between SPY and QQQ and a couple other stocks and ETFs. So I have Tesla pulled up here, so let me go ahead and pull up SPY. Matter of fact, let me do two charts so you guys can see them both. I'll have SPY on the left and then QQQ will be here on the right. Okay, so I'm going to make sure I have them both on the 1 minute just for example purposes. You guys will be able to see the correlation. You guys can pretty much see it here. Essentially what's going on is an uptrend for today. Now we see the stock prices are going to be a little bit different. We see an $81 difference between SPY and QQQ as far as the share price. However, you guys can see the uptrend correlation between the two. They don't perfectly mirror each other, but it is very similar in terms of the motion and movement of the stock. So let me zoom it in on both so you guys can see that here, and you can see it here. Okay, so again, it's not a perfect correlation, but you guys can see that the stocks do move in the same direction, and it happens quite often. So if you trade SPY and if you trade QQQ, you often see this happening, and you're able to take advantage of, if you wanted to make a play for calls or puts for both stocks, typically you'll see that they'll move again in the same direction. So I wanted to show this example so that everyone can get the clarity and of course the full overview that there are stocks that almost nearly 100% mirror each other. And again, SPY and QQQ, these ETFs essentially show you that. Now, additionally, there are financial stocks as well. So let me show you guys a few examples. One is that I like to use is going to be XLF. I'm going to pull that up here. And then I'm also going to pull up JP Morgan, JPM here. And we can see kind of the same thing. You guys can see a downward kind of trend for today with these two stocks. But again, it's also going to be showing you a pair of stocks that are correlated. Now, I went ahead and zoomed it in so you guys can see, again, both of the overview of these two assets. And we also know that these, again, are in the financial sector. So you guys pretty much catch the pattern of what I'm saying. Stocks and sometimes ETFs that are in the same indice or within the same sector essentially are going to show us similar patterns. Not always, it's not 100% every single time, but you guys do catch the trend for these particular stocks and ETFs. So I hope this makes sense. Okay, so the last concept I want to go over in this video is reading and using open interest as a sentiment measure. So we all are pretty familiar that open interest offers understanding into traders' commitment at specific strike prices, where higher open interest can act as a magnet that prices are drawn to or a level around, especially as expiration nears. High open interest at certain strikes may also indicate potential support or resistance levels, as traders with large positions could majorly influence the price action. So for example, if a stock approaches a strike with a high call open interest, it might face upward resistance as option sellers hedge their exposure. On the other side, large put open interest might suggest greater support. In essence, learning to interpret open interest data or these specific hotspots can enhance awareness near the expiration date, as these levels tend to attract price action. So overall, I hope me breaking down these more advanced concepts and how they impact a trader's risk and volatility outlook, especially in scenarios where stock movements become more correlated or decoupled, is useful. If so, feel free to leave me a comment down below. Of course, I'll make future videos going into more detail about each of these concepts, but that'll pretty much do it for this video. So I thank y'all so much for watching, and I'll see y'all in my next one.